Good day, and welcome to the Q1FY22 Earnings Conference Call of Gati Limited, hosted by Equirus Securities. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star, then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Dipesh Kashyap from Equirus Securities. Thank you, and over to you, sir.
Yeah, thank you, Stephen. Good afternoon, everyone. On behalf of Equirus Securities, I welcome you all to 1QFY22 Earnings Conference Call of Gati Limited. From the management, we have with us Mr. Pirojsha Sarkari, CEO of Gati Limited, and Mr. Ravi Jakar, the Chief Strategy Officer of All Cargo Logistics. We'll begin the call with the opening remarks from the management, and then we can open the lines for Q&A. I now hand over the call to Mr. Ravi for his opening remarks. Over to you, sir.
Yeah, hi, thank you. So good afternoon, everyone, and thank you for joining us on Gati Limited Q1 FY22 Earnings Conference Call. I'm Ravi Jakar, Chief Strategy Officer for All Cargo Logistics, and I have with me my colleague, Mr. Pirojsha Sarkari, Phil, who's the CEO for Gati. I trust all of you and your dear ones and colleagues are well and everyone is keeping safe. I also hope you've had a chance to look at the results which have been uploaded and the earnings presentation which has been also uploaded on the exchanges as well as on the company website. I would like to start with providing a business update, key highlights on the transformation program, and some key operational and financial performance highlights for the quarter gone by, the first quarter of FY22. So we have all seen that the second wave of COVID pandemic has been more fatal and has caused disruptions. However, this time we were more prepared and therefore we have been able to manage some of the trade activities better, and therefore it did not come to an absolute standstill like it happened in the last year. However, having said that, it has indeed been an impact of the lockdowns across the country, and the logistics and supply chain sector has indeed been in some stress, particularly in the months of April and May, when the second wave was at its peak. And during the month of June, we have seen that improvement, and we just continue to sustain, and we see a near normal situation at this point in time in terms of the cargo movements. And against this backdrop, despite disruptions and in challenging market conditions, I would say we at Gati have managed to mitigate disruptions faced by the entire economy and delivered a resilient performance. Gati KWE volumes were at 178,000 metric tons, which was lower by 15% compared to the normalized average quarterly run rate of 210,000 metric tons. So this 15% decline is largely on account of lockdowns and therefore reduced movements. So that's been the situation, and I said this has primarily been limited to the first quarter, and the situation seems to be much improved now. With regards to the funds infusion, All Cargo, as on 30th June 2021, has invested 27.5 crores in Gati through preferential allotment, which has led its ownership increase to 47.3%. All Cargo would invest further amounts by way of against warrants, which have also been issued. The synergies with All Cargo continues to strengthen through the cross-sell program Sangam, which has been growing well now, and both All Cargo and Gati businesses are benefiting by collaborating with each other. And there's been a steady start, and we believe it can gain significance in the times to come. Moving to our discussion on how we've been progressing on the transformation program, and we have captured this in some of our last quarterly calls as well, and I'm happy to provide the update around 4 key pillars that we monitor: balance sheet restructuring, focus on debt reduction, profitability, and digitization. On the balance sheet restructuring, we have done various activities and taken initiatives, and we are now focused on quality of cash flows and the devotion of our attention to core business, which is express, supply chain and e-commerce logistics, has allowed us to gain strength. As has been intimated, we have exited the cold chain business, and the other non-core operations also are at an absolute minimum level at this point in time. On the debt reduction side, we have further reduced the debt by another 11 crores during the quarter. This is in addition to the impact of more than 100 crores, which has come in by way of exit from the cold chain business. And this has allowed us to bring down the overall debt as well as the interest cost as well. In terms of the cost of borrowing also continues to improve, and now the average cost of borrowing has come down to 7.6% at GKEPL level and 9.2% at Gati level. We remain under constant dialogue with bankers, and we expect to continue to bring it down further in the coming quarters. On the profitability side, we aim stringent cost control measures coupled with expansion in margins, which has led to improvement in profitability. While there is certain element of operating deleverage in the existing quarter, the margins also remain impacted by transformation one-time expenses. We continue to generate similar turnaround at significantly lesser number of headcount. There remains a constant endeavor to build in certain consistency in margins, which we believe would be achieved from the second quarter, assuming there are no further COVID disruptions, which cannot be anticipated at this point in time. As we have stated, 2 to 3 quarters of normal operations should allow us to grow and expand business to bring margins to double-digit numbers. As you have spoken, we remain on path to achieving that, except for the disruption of this one quarter, largely caused by the second wave of the COVID pandemic. On the digitization, our WhatsApp chatbot Genie has received tremendous response from customers. The ease that it offers for activities such as track and trace, pickup registration, complaints, etc., has truly delighted customers. The response to implementation of digital payment system remains very robust, and we are now seeing nearly 30% of the cash collections coming in through digital platforms. So there has again been a good, strong progress across this. Coming to the financial performance for the quarter ended 30th June 2021, consolidated revenue for the quarter is 291 crores, a year-on-year growth of 78.7%. The month of May was most significantly impacted, as almost most of the states were in lockdown. And last year, it was an even more severe impact, and therefore, when you compare it with the previous year, there's naturally a very high 78.7% growth on that. Revenue from express and supply chain management divisions contributed to 82%, and fuel stations contributed to 18% revenue for the quarter. Our gross margins stood at 23.6% for the quarter as compared to 25.4% for the preceding quarter. The margins were again significantly impacted, particularly in the month of May, with exceptional moments in the cost structures given lockdown and challenging situations. Otherwise, we are nearing 28 to 30% kind of a gross margin level in the normal times or near normal times if we look at the most recent levels. EBITDA for the quarter stood at rupees 1 crore as compared to negative 22 crores in Q1FY21. Pre-exceptional PBT loss at minus 11 crores as compared to loss of minus 40 crores in Q1FY21. While reported loss stood at 21 crores, adjusting for the COSR cost, the loss narrows down to 8 crores. And this is being highlighted because the Gati COSR is no longer a part of the company and has already been divested, and therefore would not have an impact in the coming quarters. Some key highlights about our core express business, which is housed under GKEPL. The express revenues for the quarter 1 FY22 is 237 crores, a growth of 139% year-on-year. However, comparing it with the last year, as I mentioned, is not appropriate. And if you look at the FY20 average numbers, it is a degrowth of about 4%. So considering that there was a significant impact of lockdown, managing 96% of the average for FY20 has been a strong, resilient performance against challenging backdrop. The positive momentum that we were seeing in the Q4 FY21 had continued in the month of April, but towards the end of April and particularly in the month of May, which is the weakest link in the quarter, we found challenges. It continued to improve through the exit, and in the current quarter has continued. We have seen that improvement sustained on a month-on-month basis. Surface continues to remain the biggest contributor with revenues of 218 crores, which is almost 92% of Express business, and air and supply chain management contributed 3% and 5% respectively. A debt in GKEPL was further reduced by 10 crores, and average interest cost was brought down from 8.2% to 7.6%. And as I mentioned earlier, we continue to look for further improvements on this. As we've been highlighting over the past few quarters, that we seek to strengthen the leadership team of Gati. We have inducted several key leaders in the company, and now we welcome Mr. Pirojsha Sarkari, Phil, who's a veteran in logistics industry. Phil, as everybody knows him on the street, is a chartered accountant by profession and a chef by passion. In his illustrious career trajectory, Phil had set up the UPS business and organization in India and served as its MD and country head till 2010. He then joined Mahindra Logistics as its CEO, and at Mahindra Logistics, he built and fostered a great organizational culture. I have finished with my financial highlights, and I would now request Phil to comment on his journey and his views as the CEO for Gati. Phil, over to you.
Thank you, Ravi. That was very generous description of my career. Thank you for that. Good afternoon, everyone. It really feels good to be back with you all. I am sure I have interacted with many of you on the call in my earlier avatar. With India and the world setting sights on a better, brighter future ahead of these unprecedented, challenging times, the current role has provided me an opportunity to participate in an exciting transformation story. The Indian logistics industry is set to grow at 10% CAGR over the next 3 to 5 years, and niche segments like Express is expected to outpace this growth. The increasing demand for on-time deliveries, faster transit times, just-in-time inventory, and pan-India reach are long tailwinds for this sector. At the same time, what customer derives is the lower inventory cost, which in turn enables them to remain cost competitive in the market. While Gati is an iconic brand and is well known for its industry-leading network infrastructure and pioneers in India's express industry, I believe it has now entered a new intense phase of transformation and accelerated its journey towards operational excellence and unmatched customer service to establish a position of market leadership. Together, Gati and All Cargo are in a formidable position to create synergies and offer all their customers access to an extensive Indian and international network with end-to-end logistics services that only few others will be able to match. With their respective legacy and experience across diverse logistics verticals, All Cargo and Gati can offer their key customers customized solutions combining both their areas of expertise. Immense synergies could be built from the combination of this global and local leadership and I look forward to all these opportunities being crystallized by us at Gati. Before I open the floor for question and answers, just to remind you guys that I have joined on the 9th of this month, so be kind to me. Okay, I would like to open up the floor now.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Chetan Shah from Jeet Capital. Please go ahead.
Yeah, hi. Congratulations, sir, for your new assignment and wish you all the best. Sir, just one question from my side. As your role in this organization and the kind of restructuring in terms of getting out of non-core business by all cargo, could you just give us your big picture, 2-3 year vision? How do you see this company in a short time horizon? What are your priorities to look at the business, and where do you see them 5 years down the line?
Sure. So when I was discussing this opportunity with the new owners of All Cargo Logistics, I found 2-3 very interesting aspects. One is that they were very clear that they want to run an asset-light business, and as you all know, that is something that I profess in logistics. Number 2, there was large investment that was being made in the digital aspect of this business, and that is very, very essential for any logistics company to be able to grow and expand and transform itself digitally. And number 3, and most important, is the synergy that this group can derive between All Cargo and Gati. And therefore, these were kind of the 3 interesting points that got me to take on this role. I think as we move into the future of India and the world, I have said this before, that the e-commerce industry has spoiled the customers. Even the B2B customers are now looking at time-definite deliveries and faster deliveries. And historically in India, the businessmen have been keeping a lot more inventory than what is required because they did not get time-definite deliveries with visibility of when the goods will arrive. I think this is now an opportunity of reducing their costs by them keeping minimum inventory and getting service which is time definite with certainty and of course visibility. And that is what will reduce the end-to-end cost also for the customers. Express has been morphed into a service that at one point of time was very niche to a service that is now demanded by each and every customer. And I think customers are not just demanding faster deliveries, but are also demanding that there is absolute visibility in the entire supply chain. What is also important and what has come out from COVID definitely is the fact that supply chain visibility is gaining more and more importance, and dependability on a single supply cluster is going to reduce, and therefore more and more supply clusters will get developed and therefore more diversified transportation. So if you put all this together, there is tremendous opportunity for a company like Gati to reinvent itself. I have always, right from when I started my logistics career, I've always looked up to Gati to be the front runner, whether it was in technology or it was in infrastructure at that point of time. And now it's the time to kind of transform itself, I would say Gati 2.0 as they would call it, and grow it to the next level.
Understood. Sir, if I may allow to ask one follow-up question, a very short one. Sir, you mentioned about one of the three things you will be looking at. One of that is a integration and synergy with the parent all cargo. So if you can help us understand what will be the 2 or 3 numerical parameter which you will have in your mind, you being coming from a logistics background, which you want to see getting corrected or improved in Gati from a short-term 2-3 year time horizon and eventually target it for next 4-5 years time horizon. Just to get a sense that what is your important data point which you would want to see periodically and keep enhancing, improving to improve your gross margin and eventually profitability and a return ratio for the business on an overall basis.
Yeah, let me take that up. I think, like Phil mentioned, he has just joined on 9th. Today we are on 12th. So before, comprehensive plans can be laid out from his perspective, I think, it will be fair that we wait for some time. But let me say that as far as the company is concerned, we have continued to share this over the last few quarters as well, that synergies that we are speaking about are around, benefiting on the both back end as well as the customer relationship. There have been initiatives such as Gati kiosk being set up at all cargo CFSs. There have been back end synergies in terms of various functions which can have a shared group-wide center of excellence, which brings down costs and also improves the delivery and impact. And the other aspect is if you look at the potential for growth and the way growth is being driven, we have stated our objective of expanding within a rapidly growing market and gaining market share. All of this requires great amount of confidence and support from the customers, and that support and confidence also stems from the fact that the customers are able to get a variety of services from one single partner, and that is where through integrated service offerings, various customers experience what is truly an end-to-end partner which could take care of requirements for international supply chain as well as for the domestic supply chain requirements. And therefore, all of these things are helping us at Gati to optimize our costs through back-end synergies, channelize our resources better through cross-sell programs, and also improve market share on account of stronger customer confidence on our capabilities and our ability to expand a much more robust basket of service offerings.
Got it, sir. Thank you. Wish you all the best and thanks for answering my questions.
Thanks, Chetan.
Thank you. A reminder to the participants, anyone who wishes to ask a question may press star and 1 at this time. The next question is from the line of Avdul Joshi from Newberry Capitals. Please go ahead.
Hello. Hi, good afternoon. Thanks for the opportunity. 2 questions from my side. If you look at the employee cost or the number of employees from Q1 FY21 to Q1 FY22, we have reduced 400 numbers of employees. However, if you look at the employee expenses, YOY, employee expenses gone up by 2 crores. I would like to know what could be the reason for that. That's the first question.
Okay. Yeah. So on the headcount side, as you would have noticed from the last quarter as well as this quarter, there has been a continuous improvement in terms of making the whole system more efficient, reducing the headcount, and therefore this would lead to an improved salary cost as well. However, what you see in the trends is because of some anomaly, and let me highlight that. In the quarter 1 last year, we had a cost reduction, which was on account of, given the extreme impact. You may recall in the last year, in the month of April, the business was down almost 90%. Company was dealing in a crisis mode, so there were salaries which were, held back, and they were provided for in the subsequent quarters, and they were subsequently restored in the fourth quarter as we came out of the whole challenging times. So therefore, the last quarter numbers the Q1 numbers were lower than what they would have been, and the Q4 numbers were slightly higher than what they should have been. So therefore, this is an impact of one-time adjustment of salary reduction and restoration happening in 2 different quarters. Otherwise, from here on, the salary cost that you see on the headcount, these are more normal. There are no exceptional additions or subtractions in this quarter, and these headcount, salary cost levels are likely to sustain from here.
Okay, understood. Thank you. The second question is about, I think we have in Gati standalone itself, we have e-commerce business, right?
Yes. So let me explain to you. We have 2 businesses in Gati standalone: fuel stations and e-commerce logistics. Fuel station is the one which is in the process of being divested, and e-commerce logistics is a continuing business. And in GKEPL, we have the Surface Express, Air Express, and the supply chain management business.
Correct. So my question is about e-commerce. So I think you would have read about the article in today's ET Prime. So what portion of cash on delivery will be there in that e-commerce business? I think only e-commerce business will be having cash on delivery. Is that understanding correct?
Yeah. So basically, as we have spoken about the same in the last quarter as well, e-commerce currently is a very small part of our business, because when we started the transformation journey at Gati, the first objective was to divest from the non-core businesses and build a robust B2B business, which is the main core of the company, and that's what has been the focus. And at this stage, we have, over the last couple of months in particular, we have been evaluating our e-commerce go-to-market strategy and defining our playbook, which we will, how we will be operating in the market, what segments we'll be focusing on. So at this point in time, the business is very, insignificant in terms of the overall scale and contribution, and therefore it would be unfair to draw significant trends from there. In the coming quarters, we expect that, as we put our plans together and find the right strategy for growth, we would see expansion in this business. But at this point in time, in the quarter gone by, the numbers are fairly insignificant on the e-commerce business. Yeah.
Understood. Thanks a lot. Thank you.
Thank you. The next question is from the line of Kashyap Javeri from MK Investment Managers. Please go ahead.
Hello. Am I audible?
Yes, indeed.
Yeah. Thank you so much, sir, for this opportunity. One question on your opening remarks. You mentioned that, gross margins would stabilize at about, 30%, or rather has stabilized at about that number, and which is also visible over last about at least 3 years now. You also mentioned about double-digit, EBITDA margins. If I understand, at least in the surface, which is your largest, product in terms of revenue, our pricing is more or less similar to, what probably the competitors are also offering. So where does this, EBITDA margin expansion come from? Because, the next largest expense head is one employee, where, you clearly highlighted there has been reduction. But if you could help us understand what more can be done there. And then the other largest, cost is rentals and, some of the fixed costs. So how do we achieve that number?
Right. So as you rightly pointed out, there are, 3 elements which are important here: the gross margin, EBITDA margin, and the cost in between. Now, gross margin, like I mentioned, would continue to be sustainable at 28-30% level, which we are seeing right now. There's an exceptional decline due to lockdown, so the gross margin level should remain healthy. The EBITDA margin expansion would primarily come on account of marginal reduction or containing the cost which sits between gross margin and the EBITDA, while the revenue base will expand. So with the same costs, we will be doing more business by way of growing, outpacing the market growth, and that is what would be the primary driver going forward, because the transformation-led impact has largely been achieved. There would still be some more incremental gains in small delta in the gross margin and further improvement on the cost side, but a significant impact will come straight away on account of expanded revenue on the same cost base, and therefore the EBITDA margin percentage would improve naturally.
So if you were to go back to your, FY21 revenues have been achieved with slightly, or let's say about 400 odd lower employees through the year. With the same employee count, can we go back to FY, 18-19 revenues? Is that what you're suggesting?
Yes, absolutely. With very minimal, cost increase, if any, we've been able to put in a position to significantly grow the revenue, and that exactly is our plan. We do not envisage significant proportionate increase in the staffing costs while we aspire for a significant growth, and that is what would lead over the next 3 quarters or so to reach a double-digit EBITDA margin. That's what has been our plan, and we've been speaking about it, and it looks achievable.
So let's say we add another about 4.5 or let's say 450 crores of additional revenue over here to reach back to FY19 number at about 30% gross margin. That would imply about 150 crores additional EBITDA, assuming ceteris paribus everything else remains constant. Probably even in that case we probably may not reach a double digit, actually slightly less than a double digit kind of margin. So would those costs still continue to go down also, like employee and the other costs?
Yeah, so given significant
variation, to reduce them with even 1,800, 1,900 crores of revenue?
Yeah, so given significant variations across quarters during the financial years you mentioned, I would recommend that you look at the Q4 performance. We have shared an earnings presentation which details out, excluding exceptional items, the margins stood at about 8% that we have spoken about. Right. So now we're speaking about an expansion of 8% to 10%, assuming the cost base does not grow up. As the revenue base increases another 20% or so, naturally, those numbers will start appearing, right? So you can refer back to the Q4 numbers and build, assumptions around that in terms of how containment of cost and expansion of revenue would play out. It would naturally take it towards a double-digit number.
Sure. And in terms of our revenues, what would be the contribution of top 5 and top 10 customers?
It is fairly diverse, So at Gati, we work across the country, across all category of customers, whether it's pharma, automobile, textile, retail. We work across all category of customers, all regions. So it's extremely diversified.
So both in terms of individual client as well as sector, it would be pretty much diversified. Is that right?
Absolutely.
And would any single customer be in double digit?
No.
No. Okay. Thank you so much, sir. That's it from my side. Thank you so much.
Yeah.
Thank you. The next question is from the line of Pratik Kumar from Antique Stock Broking. Please go ahead.
Hello. Yeah, good afternoon, sir. My first question is just a clarification. We said that our debt reduction is 11 crores. Wondering that Gati Kaushal was sold at around 100 crores. So why the debt reduction is not 100 crores? Clarification.
I had mentioned very clearly that the debt reduction is 11 crores over and above the debt reduction achieved by way of Gati Kaushal. So this is incremental on top of that. I specifically mentioned that we achieved a further impact of about 100 crores, which has come in by way of divesting our shareholding in Gati Kaushal. This 11 crores is over and above that, like I mentioned earlier.
Seems like we lost the connection for the current participant. We move to the next question from the line of Sriram Rajaram from Ratnatraya Capital. Please go ahead.
Thank you for the opportunity. So my question is in slide number 7. We have the Surface Express revenue and EBITDA. Now, the EBITDA, what would be the normalized EBITDA for the quarter for the Surface Express?
So I think, I would recommend that from a normalized EBITDA. Yeah, I would say that, for the normalized EBITDA, it would be better to look at, from a normal situation perspective, it'd be better to look at the performance in the quarter gone by, because this quarter, like I said, has a significant impact on the disruption. And therefore, from a normal business environment, if that is what you are intending, it would not be the right quarter to look at.
No. I'm asking you what would be the sustainable number for this quarter? Because, for example, for the earlier quarter, you had a reported EBITDA of 14 crores, but normalized EBITDA of 27 crores that that was disclosed in the last presentation. So I just want to get some sense on.
Right. Okay. Yeah. So there were some exceptional items in the last quarter which we had spoken about. So there aren't any significant exceptional items in here. This is largely current EBITDA does not have any exceptional items. It is largely low because of the revenue base. The significant decline on account of the lockdowns has led to a erosion of EBITDA. And as the revenue comes back to normal levels, the EBITDA would also start coming back to normal levels. So there's no exceptional item this time, and therefore what is reported is what the actual EBITDA also is. Unlike the last quarter, where there were some exceptional items.
Okay, I get that, sir. But then if I look at the tonnage volumes, 200 versus 178 for this quarter, even if I compare Q2, we have made EBITDA of 20 odd crores in Q2. Similar tonnage was made in this quarter. So I'm just curious what happened. Is there any pressure on the cost side or something of that sort? Is there any change in SME mix or corporate? Is that why your realizations are low? I mean, any color on that?
No, so there has been no impact on realizations, except, like I said, the gross margins were impacted slightly, particularly in the month of May, which has pulled down the overall quarter as well. But if we look at the exit trends within the quarter, the gross margins have returned back to the normal levels, and we see the sustenance in the levels across the current month as well.
Okay.
Yeah.
Fine, sir. Thank you so much.
Thank you. The next question is from the line of Neelam Punjabi from Perpetuity Ventures. Please go ahead.
Yeah, thanks for taking my question. Would it be possible for you to break up your revenue for the quarter into April, May, and June? What was the revenue number that you did?
So I can comment on the trend. We do not share the monthly numbers, but like I mentioned, May was the most significantly impacted month, and April was when the decline had just started, and June has been the month of recovery. So April to May was a sharp decline, and then June has seen some recovery, particularly towards the last 15 days of June, and that has sustained during the month of July. So if we look at what we were doing in the normal times in January, February, those numbers have been achieved back, let's say, in the last few weeks or so. So if you look at the daily or weekly averages, we are now almost back to the pre-second wave numbers. But May was the worst hit among the 3 months.
Got it. That's helpful. And just one more question. If I look at your books, so in the balance sheet we have goodwill of 426 crores. Can you just tell me what's that pertaining to?
Yeah. I'll just request, just give me a moment. So this is basically at the console level. If you look at the goodwill is 425 crores, and this is something which has been sitting in from earlier times when Allcargo acquired Gati. It came along at that point in time, and out of this 125 crore is at GKET level, which is the main operating subsidiary. So at the console level, this is basically goodwill coming in from prior actions, which has continued to be in the books. At the GKPL operating level, it is 125 crores. And we can share further breakup of this in the subsequent communications for further clarity.
Got it. That's helpful. Thank you. That's it from my end.
Thank you. A reminder to the participants, anyone who wishes to ask a question may press star and one at this time. The next question is from the line of Prateek Kumar from Antique Stock Broking. Please go ahead.
Hello. Yeah, apologies. My call dropped. Sorry if you have already answered this question. I was asking about your debt level. You said 100 crore has already been received. That over and above 11 crore is the reduction in the overall debt, right?
Yes, Prateek. So the reduction in debt is 11 crores over and above the reduction caused by the Gati cost divestment. So this is incremental of that 100 crore plus impact coming in from Gati cost.
So FY21 net debt of 290 crores comes down to around 170 crores.
Yes. So there has been an impact of total impact of about 110. Yeah, that's right.
Right. And also when we say
290 have now come to 176 to be precise.
170. Oh.
Yes.
And when we say that, this about debt again, this is largely, as we have indicated earlier, is now related to working capital, or there's some loan also remaining here?
So there's sort of trouble, but largely if you compare, 176 crores as a consolidated debt for a company doing 100 crore plus kind of turnover on a monthly basis, it is not far from working capital. Out of this 176, 138 is approximately working capital, and only about 38 crores is other debt.
And any timelines or any numbers further on the divestment of non-core businesses, including fuel stations? How much more incremental money we are looking at for current year?
So like we shared the guidance earlier, it remains unchanged. And given the whole pandemic scenario, it would take up to 4 to 6 quarters to fully realize the sale of various small land parcels or other non-core assets that we have. So this is work in progress. There's no change in what we have stated earlier as well on that.
And one question on your margins. So when we say double-digit margins, is it 10% we are indicating, or is it like some teens number, mid-teens number, or some of the peers have started to doing those kind of margins?
No, so we have been talking about a 10% margin in the near term, which is 3 quarters ballpark here or there. And then our aspiration is to take it to 12% or so. We believe 12 to 13% is the gold standard in our business, the way we operate. Now, as you would recognize, the EBITDA margin can vary from one operating model to another depending upon whether assets are owned and therefore impact is sitting under depreciation, or assets are rented and therefore the costs are sitting above EBITDA. So there could be further final nuances as well. As a company, we would continue to focus on being absolutely asset light, and with our kind of operations with no intent on asset ownership, we believe that 12 to 13% should be the gold standard EBITDA. That's what has been the target, and we aspire to achieve that in a sequential manner, first reaching about 10% and then further expanding that with incremental transformational initiatives and incremental, leveraging the same cost base to expand revenue. And that should happen over another subsequent 3 quarters or so. So that guidance remains the same.
And in this particular quarter, we said that we have no exceptional and all of it is relating to operating deleverage. But we also said that we had some transformational related expense during the quarter. So was that not material?
Yeah, there is not material to cause a significant impact. I would not call that out this quarter was largely led by, the impact on the revenue, which came in on account of the lockdowns.
Sure. Thanks and all the best. I'll get back to the queue.
Thank you. Next question is from the line of Nimesh Shah from MK Investment Managers. Please go ahead.
Yeah, thanks for this opportunity. So I had a few clarifications. So the express business revenues this quarter that we did of about 237 crores, will that include surface and air express, or there is some other business in that as well?
So if you refer to our earnings presentation, we have spoken about all in detail. We have spoken about the Surface Express, which was at about 218 crore, Air Express, which is about 8 crores, supply chain management revenue, which is about 11 crores, and e-commerce revenue, which is about 4 crores.
Right. But then if I just add up, which all, then you also separately mentioned express business. So just wanted to understand, because the previous number years weren't tallying. So if you see Q4 number, the revenues were at 300 crores, but if I have to add up all the 4 business, the number was a bit higher.
The 300 crores is the Surface Express itself in Q4, which has now come down to 218 crores. That's the segmental performance. And just to explain to you the structure again, the way the business is structured is e-commerce revenues are part of the standalone Gati entity. Under Gati, we have the subsidiary Gati KW, which is GKETL. Surface Express, Air Express, and supply chain management form part of that. And Surface Express and Air Express would contribute towards Express of GKETL, and SCM would be the SCM of GKETL. So the e-commerce revenue is in the standalone entity, rest all is in the subsidiary GKETL.
Okay, got that. Okay. So in the Surface Express, can you give some sense on what will be our mix? Say how much will be corporates and how much will be SMEs for us?
So if you look at the distribution, it is well distributed across the key enterprise accounts, the SMEs and retail customers. And we would find that the SMEs would be growing slightly faster in the subsequent quarters to follow, while the KEs currently are the biggest segment, almost accounting for nearly half of the total revenues, and that is likely to remain that way. And retail is approximately about 20%. You can also refer to our earnings for detailed breakup as well.
Okay, sure, I'll do that. And another question: are we also how many vehicles do we own, or is it completely outsourced for us?
It's completely outsourced, and whatever minimal equipments have been lying around, those are also in the process of being almost 99% plus have already been sold off. We operate on a completely asset-light model, wherein we hire the equipment.
Okay. And lastly, on the supply chain management business, so can you share some breakup between how much will be warehousing and how much will be 3PL?
Sorry, I didn't understand your question.
In the SCM business, are those revenues completely on the warehousing services that we provide?
Yes. Yeah, that's completely warehousing services. Inventory management is all revenue within the 4 walls.
And what kind of margins would we be doing in that business?
The margin profile is more or less similar across the supply chain and the Surface Express. So it's almost a similar 8% kind of a number that we witnessed in the last quarter. This quarter, again, like I said, was a bit of an exceptional item, and therefore would not be the right quarter to look at. But there's no significant delta between the margins of Express and the supply chain management business for us at this point in time.
Sure. Yeah, that's it from my side. Thank you.
Thank you. The next question is from the line of Aditya Shah from IIFL. Please go ahead.
Hi, thank you for taking my question today. I just had one minor clarification on the other expenses. Were there any costs related to the Gati Kaushal transactions, so professional fees, stamp duty, anything like that were part of the other costs this quarter? Any material way?
No material costs in there.
Okay, understood. Thank you. That's all I have. Thank you very much.
Thank you. The next question is from the line of Abhijit Mishra from ICICI. Please go ahead.
Yes, thanks for taking my question. So my question is on the express business. Can you mention the gross margins for this quarter and for the last quarter in the express business in percentage?
Yeah. So, like I mentioned earlier, the express business largely contributes to the overall business, and therefore the gross margins are truly reflecting that only if you take out the fuel stations. Approximately 28 to 30% is the normal level, but in this particular quarter, because of the lockdown impact, the margins were subdued. Otherwise, in general, 28 to 30% is the number, and we have been close to that. So this quarter is also approximate. So we should be doing about 30%, which was the number in Q4, and this quarter is about 2% down because of the marginal impact, which is about 27.9 in the express.
Okay. So essentially, your gross margin per ton has not declined. It's essentially the fixed cost which has taken out the entire EBITDA. I think that's the...
Yes, largely the revenue, the margin did not decline that much, but the absolute impact, and like I said, there's been a marginal decline from 30% to 28%, and then on top of that, so this let's say 2.3% impact on the revenue, and then percentage terms, but then the absolute terms made an impact as the cost base remained same, right? So that's the fixed cost largely, and that's where the EBITDA has been eroded.
Right, and also a conceptual question. See, it's a franchisee-led business. So why should the cost levels be higher than say a business which is being run through owned branches? Just to sort of get a hang around it. Employee cost is also higher. Your rents are also higher. So
rents are higher is an absolutely true indication that the properties across the country are leased, and we do not own any of these branch offices, etc., which are part of the network. And that is exactly the point, that if you have these costs sitting in as rental, they would impact the EBITDA margin as compared to those costs sitting as your own assets and therefore sitting below EBITDA.
But the franchisees, the offices that they're sitting in is being rented in your book, just to understand.
No, so it's not an entirely franchisee network. Obviously, a franchisee office rent would not be sitting in our books, but we have our own offices across the country, right? And that's the cost. So if you look at the rental costs that we pay out, those costs are on us. The franchisee rent is obviously not on us, but the cost that we pay out, what you see as a rental amount, that rental amount is higher because the properties are not owned. And that is the intent as well. Whatever is the true cost of running this network, of managing this operations, we would continue to focus on, so let's say there are company-owned, company-operated outlets. There are franchisee ones. The franchisee ones obviously are not on us, but wherever we are managing the operations, those costs are on us. And across, the intent is to be asset-light and therefore taking these properties on rent and not owning these properties, and which is why the rental is high.
Right. And it's also, to understand the employee cost, why should employee cost be higher? I mean, is the incentive sitting in to the franchise sitting in the employee cost?
Yes. Employee cost is compared to what?
To the other, own branches model. As a percentage of top line.
No, so employee cost, I would say, we are only looking at our own benchmark. I'm not in a position to comment upon what the employee cost for a competitor could be. As far as our own employee costs are concerned, you would have seen that at one point in time, Gati had 5,000 plus workforce, which has been consistently coming down. Over the last 12 months, we brought it down by 800. It has further gone down in the last quarter. So since All Cargo's takeover of the management and the company about 15 months ago, the focus has been to make it more efficient and lean, and which has been reflecting quarter on quarter with significant reduction in the headcount. And that is the journey we have undertaken. So if you look at from Gati's own benchmark, particularly the last quarter 4, which was normal, you would have seen that despite handling high volume, the highest volume and turnover recorded for Gati surface express ever, the headcount was almost 800 people fewer. And then we have been able to achieve further reduction on top of that. So I think, we are only in a position to compare the headcount against the historic levels, and there's a consistent improvement on top of that.
Great. Thanks. That's all from my side.
Yeah.
Thank you. The next question is from the line of Preet from Wealth Investor. Please go ahead.
Yeah, sure. So what I wanted to understand more is if you can give some commentary on the competitive intensity. The context I have is that you have these traditional players like PCI Express and Safe Express doing well, and on the other hand, you have the newer ones like Deliveries and others getting into the express side. So how do you see Gati performing with this kind of mix going?
Yeah, so I think, it is like my colleague Phil was mentioning in his earlier comments, these are wonderful times when the customers are more focused on managing efficient, time-bound supply chain. And there's an expansion on the supply basis as well, which means that express logistics is only going to become more critical, not just in B2C, but also in B2B. And therefore, the industry, which is still a small segment in the overall logistics spend in the country, should be in a position to witness strong growth. So therefore, as more and more professional players have come in, it has only helped expand the industry, provide service differentiation to customers. As far as the competitive landscape is concerned, ultimately, I would say there's no differentiation between a legacy player or a new player or anything like that. In the customer's mind, customer wants supply chain solution services, and it does not matter when, or what categorization of the company is. Each of the service providers have to ensure that there's digital integration with the customer. There is clear visibility of the cargo. There's clear adherence to the service levels. And in doing all of this, it is important to maintain cost efficiencies, because ultimately logistics cost is an important parameter, and which leads to requirement to run an efficient network, fully utilized, well-loaded trucks on the roads. And therefore, as far as the competitive landscape is concerned, I would say that companies will continue to focus on operational excellence, continue to focus on digitization and making use of technology, both for improving operations and engagement with customers, as well as for analytics to drive business better. The companies should do well. That's what our sense is, and which is why we have focused on the holistic transformation program that we've been undertaking. And we are confident that this positions us very strongly in the competitive landscape that we have, and which is why we have aspirations what we perceive to be, or we expect to be, a high growth in market. We also have aspirations to expand our market share, which means that we have to grow faster than the average market growth rate of the organized players that we compete against.
Okay. A couple of other small questions. One is, what is your truck utilization percentage right now?
There's a disruption, but I think you spoke about the truck utilization. So those levels have remained in, high 80%.
In 80%. Okay. Second is, there has been increase in fuel prices. So how do you handle that with your customers? Is that a pass-through or is that contract-based?
Yes. So the diesel price hike is largely a pass-through item. It is provided for in various agreements that we sign with the customers, and it does not have any significant impact. It gets passed on to the customers.
And in your express business, how much is B2B versus B2C?
So the express business that we speak about in Gati GKEPL is entirely B2B. The only B2C segment is the e-commerce, which is under the Gati parent entity.
Understood. All right, great. Thank you.
Thank you. Ladies and gentlemen, due to time constraint, that was the last question. I now hand the conference over to the management for their closing comments.
Yeah, thank you all for joining us, and we hope that we all avoid any further COVID waves, and all of you and all the family members stay safe. And as the environment returns to normalcy, at Gati we continue to work towards our transformational journey of driving growth through business excellence, We will continue to remain focused on being asset light, digitally enabled, and we would continue to work on our aspirations to gain market share. And with further enhancements in the management bandwidth, with Phil coming in on board, we are very confident we'll continue to demonstrate strong performance. We look forward to being in touch with you, and thank you very much for joining on the call today.
Thank you. Ladies and gentlemen, on behalf of Equirus Securities, that concludes this conference. Thank you all for joining us, and you may now disconnect your lines.